Hello everyone, it's Rob Murphy at Edison Investment Research. Very pleased to have once again on this slot Riverstone Credit Opportunities Income Fund. I'm delighted to have Jamie Brodsky and Chris Abbate, who are co-heads of Riverstone Credit, and we're going to go through, review what they've been doing recently. There have been some changes to the fund in terms of how it's positioning itself from a sustainability point of view. So let's just crack on. Welcome, guys.
Thank you. It's good to see you.
Appreciate it.
Brilliant. So as people will know, I'll just call it RCOI, is a credit investor focusing on energy infrastructure. We've seen, obviously, in the last year or so, supply issues in traditional energy markets, which have had quite a big impact on energy prices. But at the same time, the world's moving to transitioning to alternative sources of energy. So how is RCOI positioning for these trends in terms of the types of projects that you're funding now?
I'll go first. Jamie, you can chime in. But Robert, it's a great question, and I think the way we think about RCOI really is that it is a pure play energy transition investment opportunity, because we see the continuum of energy as being just that, a continuum. On the one hand, energy demand is increasing year over year as population increases and the demand on everybody's devices and everything they're doing goes up. There's you need a lot more energy. Meanwhile, obviously though, climate change is real, and the world needs to take it very seriously and act dramatically to reduce carbon emissions. So there's a huge challenge. How do we meet the growing demands of energy and at the same time decarbonize? And I think our view on this is that you can't pick only one way to do it. You have to look at things as a continuum. You have to go back and look at the existing infrastructure and do everything you can to expand it and decarbonize it. And you also have to invest in newer forms of energy, that are going to be greener and cleaner from the get-go. And I think that's what we're doing at Riverstone. You raised the supply issues, but we think there is a big risk to transitioning, too quickly, because we're seeing the impact of underinvestment in conventional energy. As funds flows and sort of investors have really leapt into the green energy revolution, if you will. But what that's led to is declining production, which has led to much higher oil and gas prices, which are going to impact consumers in the short term. It's also led to price shocks. Obviously, you've seen electricity prices in Europe this winter spike because of shortages in coal and in natural gas, or the cost of natural gas going up. We had a similar incident here last winter in Texas, where there was freezing of power plant infrastructure because it wasn't hardened, wasn't sort of invested properly. And as a result, we had 100 people die. So it's very serious stuff. And we think our fund and the deals that we do can really help that transition by helping to decarbonize existing energy sources and grow newer, greener sources going forward.
Yeah, it's interesting. Yeah, sorry, Jamie.
Oh, right. Rob, the only thing, I'd add is, we've always prided ourselves on being, sort of industry, right? We're an energy company. That's, sort of all we do. And I think inherent in that, originally is you're relatively agnostic on how energy was formed, how it was created. How do we, cheaply power the world? That sentiment has shifted a tremendous amount, in that it's not just how cheaply can you power the world, it's how clean can you do it, right? And so Chris and I, through our careers, we've been at the forefront. We've been 1.5 miles under in coal mines. We've been all over every hydrocarbon producing basin in the world to a certain extent. We've been on vessels that have been looking and working on putting on wind farms on. Today the mandate is to help the energy infrastructure evolve such that we are able to make sure that we're producing as clean energy and power as we've ever done. And so the opportunity set has shifted a bit for us. It wasn't just financing the production of energy. Now it's how do you do it in a much better, much cleaner, much more efficient fashion, and that transition is really where we're focused today. And it's daunting to a certain extent, but it's a massive opportunity set.
Yeah, we can come on to that later. A couple of questions on that. But I guess when I look at the shares, the discounts widened recently, and the yields back up to 8.3, and it seems to be correlated with kind of oil and gas prices. So, I mean, is there much direct exposure to oil and gas prices? Do you have any E&P exposure now?
No, I mean on the E&P side, we've blown down that entire portfolio. When I say blown down, I mean those deals have been refinanced off. They've been quite successful, actually, just in terms of the returns and that they've generated. But it's been almost 2 years since we've done a new upstream oil and gas deal. I think the way we look at it is that coal has been the tip of the spear, and we've been away from that for a long time. Sort of the next most I'd say argumentative or volatile part of the sphere is upstream oil and gas, E&P. So we've moved further from the wellhead, so from a direct commodity price exposure, we're about as far as we've ever been from a portfolio perspective. We do have exposure to oil prices, gas prices, and a lot of other things, but no one underlying commodity is what's driving the share price. There's a lot of, we can talk about the share price for an incredibly long time, and why it may be reacting the way it is, but it's not a function of the commodity price. It may be a function of sentiment around how people perceive us, if they just perceive us as an oil and gas focused firm. But if you look through the portfolio and you look what we're doing, that's clearly not the case.
Yeah, and I think that's probably been demonstrated. I mean, if we look again through the last 18 months or so, we've had, I think, negative oil prices at one point, and then we've had the big move up, and you guys have pretty consistently been paying out those dividends, and they're covered by the cash flows off the portfolio. So, certainly the dividend hasn't been, being blown around by those kind of moves.
We had a good laugh. Somebody showed us, sort of the trading performance of our, kind of the peer income trusts, and you saw the discount of relative players by industry, and the premium was really for people in sort of the renewable space or the infrastructure space. And we're looking at our discount. I'm like, well, but we do renewables and we do infrastructure. Unclear what the huge disconnect is between us and them, but that's part of why we spend time with folks like yourself, right? I mean, there is a messaging element to all of this that needs to be told, and but you're 100% right. I mean, when you look at the results and the returns and just the deals that we're doing, it's not an oil and gas fund.
Yeah, and I guess, just to follow on from that, so we talked about the kind of projects that you're financing, but the actual loan structures have changed now, and you've been doing sustainability loans and green loans and certified loans. I mean, could you maybe talk through what the differences are between the kind of loans you've been doing, and what that means for the borrower? And maybe you've got a couple of examples of deals that you've done.
Sure. So you're correct. All our deals going forward will either be green loans or sustainability linked loans. These are both governed by principles that are published by the LSTA, which is the sort of the self-regulatory body for lenders in North America, at least. And I think the way we do it is, a green loan is something that has a green use of proceeds, largely speaking. So clearly any renewable forms of energy, and many other things as well that, reduce or reuse or recycle things, all of that will be, counted towards green loans. But as a new opportunity comes in, we run it through the green loan principles, and if it applies to that particular opportunity, then it'll be a green loan. If it doesn't, then we'll look to structure it as a sustainability linked loan. And here, the nuance is that really any company you can make a sustainability linked loan to. All you need to do is identify what their sustainability goals are, typically set by the board and the management team. You make sure that those goals are measurable and auditable, and then you tie the loan economics to the company meeting those goals. So, the board sets the goal and we just measure it and audit it. And if they hit it, there's no impact. If they don't hit it, it starts to cost them more in the cost of their loan, right? We're very confident about being able to make the statement that every loan will be either green or sustainability linked, because doing due diligence on these companies and finding out what their sustainability goals are is a core part of our underwriting process. And if frankly we found a company that had no sustainability goals whatsoever, they'd either already be green on the one hand, or they wouldn't be someone we'd want to lend money to. So it's a pretty simple thing to promise that we'll do it that way. In terms of examples, we did the deal for Blackbuck Resources last June, which is a water infrastructure and recycling company. They operate in the Permian Basin in Texas, and they basically take wastewater away from well sites via pipeline, and then they, in some cases, reuse that water for other purposes versus just disposing of it. What we did there was we essentially tied some loan economics to their objective, which was to get as many trucks off the road as possible. And just for reference, a truck can carry about 120 barrels of water, and these wells are producing thousands of barrels of water a day. So by laying a pipeline and getting that water to where it needs to go without using a truck is actually very dramatic in terms of the reduction of emissions on the one hand from all the trucks on the road, but also it's a big safety issue out there. We think we're going to save a lot of lives by laying those pipelines. So in this case, if they don't hit their truck trips avoided sustainability performance target, their pricing steps up. And we gave them 2 different levels, one in the first year and one in the second. And I believe it's an aggregate of 75 basis points increase to the coupon if they fail to meet the targets. The second loan we'll talk about is Circulus, which is a plastics recycling company that we helped finance in August of this year. They are building a series of plants across the U.S. to take used low-density polyethylene, which is essentially plastic, water bottles, packaging and whatnot, and then convert that into a reusable form of plastic. They call it a post-consumer resin that is sold into the packaging market. This qualified as a green loan because it clearly is reusing the same material again and therefore reducing the need for additional energy production. And this is just a great little business. They buy the used LDPE at a discount to an index, and they sell it at a premium to the index, locking in a margin, and it's essentially a fixed fee processing business, much like many of the other midstream companies that we've lent to historically. There's no economic consequences, but we do have to monitor the use of proceeds, make sure it's going for what the intention is, and also that that they don't change their business purpose. They don't go into coal mining or something like that down the line. That would be a violation and cause a default. So, but that loan is structured as a green loan. And I think you'll see us do. We don't know the number, but we're kind of ballparking 50-50 between green loans and sustainability loans as sustainability linked loans. Apologies, as we go forward.
Yeah, that's interesting, and I guess. some people question whether sort of being more sustainable will affect returns going forward. But I think you had your first exit not so long ago on a solar project, so maybe you could talk about the kind of returns you made on that.
Yeah, sure. I mean, I think our returns have been consistent, and this starts at underwrite. We typically look to underwrite something to kind of a gross mid-teens return, and on balance, that should be around sort of a 1.15 to a 1.25 on your money. And I think you could say that we're total return focused. How we make that. It's a combination of factors: upfront fees, drawn spread, undrawn spread, because we'll do delayed draw loans, and then also exit premiums. And if you follow us, you know that our exit premiums typically get more expensive over time, which is counterintuitive to most direct lenders who want to sort of file and forget. They want to do a deal, keep it out as long as possible, so you can build your multiple of capital. From our standpoint, the nature of the industry that we're in, giving a developing company money for any longer than they need it, you're just asking for increased risk, right? And so we're very big on behavioral economics. We're very big on trying to ensure that the borrower is using our money at the right time for the right use of proceeds, creating collateral value, and then when they don't need it anymore, to pay us back. And Project Mira or Aspen was no different, right? It was a 1-year loan, basically. We were solving a need. That's how we were able to get that deal, is we were able to understand where the company was in the life cycle of its development, help the company bridge it to getting to a point where it was going to be able to sell those assets, or get to NTP at a various different project, and ultimately be able to refinance this with a cheaper cost of capital. And that was right in that return threshold that we look for. In that instance, is actually, I think it was a little bit higher. So part of what we've always done is go where others don't. Direct lending as an asset class is massive. It is trebled in size, if not more, since the great financial crisis. But almost by definition, big generalist direct lenders have avoided the energy sector, which is quite counterintuitive, because when you look at the banks and you look at the high yield market, they've always been massive purveyors of capital for the energy sector. So our business model was predicated on an asset-based lending approach, short duration lending, go out where others aren't. Today, we're doing the same thing. We're just evolving, right? And nobody should be able to evolve as good as us. Doesn't mean we're not going to make mistakes, but because we operate off of a massive energy platform, over a $40 billion energy platform that's been investing across this asset class for decades, we should see trends sooner than others, right? And be able to move, which is really what we're doing. That's how the strategy, when you looked at RCOI from inception in 2019, when it was kind of all things energy, largely upstream, midstream, downstream power, even coal, what have you. Today it's infrastructure services, so energy infrastructure services, and energy transition. And the last 6 deals that we've done really highlight that. And as you sort of mentioned, Rob, there's been no, the dividend has been stable, even with the velocity and of the commodity prices and what have you. But it's just about going out and being able to do these bilateral deals with the right alignment, and deliver these returns to our investors as we promised.
Yeah, I mean that'll make sense, obviously, because there's huge amounts of capital going to be required in all this transitioning, as well as just the existing delivery infrastructure. So, I mean, do you think borrowers are more incentivized to use these kind of green loans now? I mean, as part of their own kind of ESG sort of policies and speaking with their investors?
We've found tremendous reception in the borrower universe to this strategy. They view it as a stamp of approval that Riverstone would make them a loan in the first place, and that, you know, if they can label it a green loan or a sustainability linked loan, that plays very well with their constituents. You know, their employees, their shareholders, their board members all want to be seen doing the right thing by this, you know, energy transition. And getting that label, you know, because we've taken it through the process to, you know, look at the principles and see if it qualifies, you know, that it has meaning to them. So absolutely, people really look at, I mean, for the first time ever, we're having borrowers putting out press releases when we lend them money. We always did for our, you know, when we make an announcement, we put an RNS out on making a new investment, but now we actually have our borrowers, you know, pounding their chest saying, "Hey, I just got money from Riverstone, and it's a green loan or it's a sustainability linked loan." They really like that.
Yeah.
Yeah.
Great.
To a certain extent, right? You know, what we're doing with that is we're holding the borrowers to a higher standard. We're holding ourselves to a higher standard, and you know, the borrowers look at it and they tell their board that this is, you know, what they're doing, and they want to tell their you know, their investors this is what they're doing. So the sort of right way sort of, you know, risk, or you know, with all of it, right? So it's kind of a mutually beneficial construct when, you know, they enter into these sustainability sort of constructs. So yeah, we're definitely seeing them want to take advantage of the marketing of it, which is nice, which is great. It's where, you know, it's where we need to be as an industry, without a doubt. This is how this is all going to happen in a manner that doesn't result in chaos and, you know, the reliability of the grid suffering, and you know, the cost of, you know, powering our homes and our vehicles, you know, doubling and tripling, right? It needs to be disorganized, a more organized fashion, and we need to be on the same page with you know, both the investors as well as the consumers of the capital.
Absolutely. So, I mean, maybe to wrap up, I mean, what kind of opportunities are you seeing out there now? Where do you see yourself most likely recycling your capital in the next, you know, coming months and quarters?
Sure. So we're running this sort of continuum, but you know, broadly speaking, we see a handful of interesting themes that we're approaching. You know, maybe I can take one or two, and Jamie could take one or two, but you know, one is you know, traditional midstream infrastructure, expanding the delivery of gas and crude oil in a way that's more efficient, but doing it in a cleaner way. All of those loans will be sustainability linked loans, most likely, and will be, you know, trying to achieve specific targets around emissions, most likely, in terms of how much carbon they put into the air as opposed to transport. So we see a big opportunity there. Also conversion of a lot of existing infrastructure to a greener purpose. You know, just you know, we have seen you know, refineries get converted to renewable diesel, for example, and financing that conversion, or taking a coal-fired power plant and essentially taking out the coal boiler and putting in you know, batteries for storage, and using the interconnect to the grid as a way to stabilize the grid and sort of get you know, as intermittent sources like wind and solar come in, storage is going to be important. Taking that sort of baseline coal offline will be, you know, something that, you know, requires that. So, you know, financing those kind of things we find really interesting. And then maybe finally, and along similar veins, but we see a huge opportunity in the waste to value play. So, you know, the Circulus deal is a perfect example of, you know, you've got waste that's going to go in a landfill. So you're taking carbon that was produced out of a well and converted into low density polyethylene, and you use it once and you stick it in a landfill where it takes, you know, 1,000 years to decompose or whatever. Instead, we're reusing that, right? And not only are we reusing it, we're, you know, that obviously, you know, limits the amount of new carbon we need to take out of the ground in the form of additional gas production, right? So that waste to value theme, we've seen that with used motor oil recycling. We've seen it with used cooking oil goes into renewable diesel A lot of animal waste can be made into renewable natural gas. Dealing with flare gas is a big issue. Whether that's just really turned to sales, frankly, which is a good thing because, otherwise, the carbon emissions from burning natural gas in a proper furnace versus lighting it on fire in the field is a massive difference in terms of global warming. So, that is something that we're focused on, but also using that flare gas for good. Powering computers, powering things in the oil field, electrifying the oil field. In that way can really help reduce overall emissions. So those are things we're focused on. Jamie, I know there's a couple things as well that you're looking at.
Yeah, I mean, just kind of put a wrapper on it, right? There's a common theme, right? It's not just we'll only do renewable energy, right? And if we were just focusing on, commercial solar or wind, or hydro, it's clean, but one, that's an incredibly overbanked space to a certain extent. There's tremendous amount of capital chasing it. Therefore, the returns just aren't there, especially if you're backed by utility grade contracts, what have you, right? It's just not the business that we're in. But being able to go after these opportunities that really are, we call it kind of pure play transition, that makes a tremendous amount of sense and really can have the same effect as some of those other just a pure play renewable deal, right? Because if you think about it, if you just avoid the hydrocarbon space altogether, you take a deal like Black Buck that Chris walked through, right? That's a wastewater disposal company, right? That wastewater is really generated in the drilling of an oil and gas well, right? But if we ignored that company, right, that would ignore the thousands of trucks that will be taking off the road, and the emissions and the fatalities that could be associated with that. If you look at the deal that we just did for a company that removes sulfur from the gas stream, one of the end results of that is that there's more natural gas to sell for a company, not necessarily what somebody who's just completely environmentally focused wants to hear. However, the alternative is they're burning that gas and they're flaring it into the air. So the result of us backing the company that's helping to desulfurize the gas stream, creating an organic kind of elemental sulfur product that can be used, disposed of, can be made into fertilizer, plus have a cleaner gas that can now go into a pipe and be sold. If we just avoided that, we'd be missing the opportunity to assist in facilitating a massive mechanism to remove methane emissions and carbon emissions into the environment. And so a lot of what we're doing, waste, the waste to energy, it is in that sort of mindset of how do we facilitate this transition. And then there are the Aspens, which are the community solar, and we're looking at a ton of hydro stuff and more pure play. We just have to do it in a mechanism that makes sense for our type of lending, our short duration project style, where we can make our type of returns.
Excellent. That's a great summary. It's all about impacts, really, isn't it? Sort of what difference you're going to make. That's really great to speak to you, Jamie and Chris. Thanks once again.
Thank you, Rob. It's great to see you,
Rob. To the Edison team, we appreciate the interest and the guidance along the way. So stay well. We'll talk soon.
Bye.
Take care, guys.